Good morning, everyone. Today, we'll be diving into an in-depth analysis of mathematical decay in crude oil ETFs. Our focus will be on the structural evaluation and optimization strategies for long-term asset allocation, as presented in this strategic research report for 2026. We'll begin by examining the market structure and the phenomenon of value erosion. This section will explain precisely why futures-based ETFs are structurally unfit for long-term holding. The core of this problem lies in negative roll yield mechanisms. First, we have contango. This occurs when far month prices exceed near month prices, reflecting storage costs and carrying fees. This is actually the default state for oil markets. Second, we see roll losses, which are mathematically forced losses during the rollover process. This involves selling cheap near-month contracts and buying more expensive far-month contracts. Finally, the result of these mechanisms is divergence. This means that value erodes even if spot prices remain flat, causing the ETF's net asset value to permanently disconnect from the physical crude oil spot price. To illustrate, let's look at some major U.S. futures-based ETFs. The United States Oil Fund, or USO, employs a front-month futures strategy, carrying a high decay risk but also high liquidity. The United States Brent Oil, BNO, focuses on Brent crude futures as an international benchmark. The United States 12-month oil, USL, uses a laddered strategy over 12 months, which helps with moderate decay mitigation. Lastly, the Invesco DB Oil Fund, DBO, utilizes an optimum yield strategy with dynamic contract selection. It's important to note that front-month exposure, while most sensitive to short-term price movements, suffers the highest roll costs. This isn't just a U.S. phenomenon. Looking at Japanese market perspectives, major Japanese tickers like 1699, 1671, and 2038 explicitly state in their annual reports that contango can lead to fatal divergence from spot prices. The consensus is that these vehicles are best for day trading and are generally unsuitable for holding beyond a year. However, there are strategies to mitigate erosion. One is the laddered approach, exemplified by USL, which distributes contracts equally over 12 months to smooth out localized contango spikes. Another is the optimum yield strategy, used by DBO, which analyzes the futures curve to dynamically select contracts with the least contango or most backwardation. A third approach is swap-based, such as OILK, which uses OTC swaps instead of direct futures to improve tax efficiency and administrative convenience. But what if we could shift from negative carry to positive dividends entirely? This brings us to the energy equity solution. If mathematical erosion stems from maintaining futures positions, the solution is simply to avoid futures altogether. Equity-based exposure provides a structural advantage. Examples include XLE for U.S. majors like Exxon and Chevron, VDE, which is diversified across over 100 firms, and IXC, offering global exposure including companies like Shell and Total. Let's consider Japanese domestic energy stocks. Ticker code 1618, NF Energy Resources, offers a compelling alternative. It boasts 0% roll costs and a high dividend yield. This fund tracks the Topix 17 energy resources, with major holdings in INPEX, ENEOS, and Idemitsu Kozen. It benefits from rising crude prices through inventory gains and production margins, entirely avoiding the mathematical trap inherent in futures contracts. Now, let's conduct a comparative analysis of suitability between futures-based and equity-based investments. For holding cost, futures-based vehicles exhibit negative carry due to high roll costs, while equity-based options offer positive carry through dividends. In terms of correlation, futures are direct to the WTI spot price, whereas equities correlate via profit margins. Best duration for futures is typically days to weeks, suitable for tactical plays, while equities are ideal for months to years, a strategic approach. Finally, futures-based investments face severe mathematical risk from contango, whereas equity-based investments are exposed to market and corporate earnings risk. Understanding the mathematics of volatility drag is crucial. The decay cost is approximately equal to the leverage factor times volatility, squared, divided by 2. This means that if you increase the leverage factor, L, returns increase by L, but the decay cost increases by the square of L. Furthermore, high volatility, represented by sigma, in choppy markets causes value to evaporate rapidly, even if prices end flat. The logistical conclusion is clear: leveraged oil ETFs, such as UCO or 2038, are strictly for ultra-short speculative bursts and should not be considered for investment. To summarize, here's our strategic horizon roadmap. For tactical bursts, spanning hours to days, leveraged ETFs like UCO are used for speculative profit and price sensitivity. For weeks, futures ETFs like USO are suitable for momentum capture. For a portfolio tilt over months, optimized ETFs such as DBO can be used for trend following. And for structural asset allocation, spanning years, energy equities like XLE are the choice for long-term wealth accumulation. Thank you for your attention today. This concludes our structural evaluation of energy asset formation. You can click below to export this presentation to Google Slides. This report was prepared with analytic support from the Quantitative Finance Research Unit in 2026. For transparency, here are the image sources used in this presentation, all from Vecteezy.